All right, good morning, everybody. I'll go ahead and start the meeting. First thing, as always, I'm going to take a moment of silence for those who have passed since our last meeting. All right, thank you. So our first agenda item this morning is approval of the May 23rd minutes.
Second.
All those in favor? Aye. All right, thank you. Motion's carried. So Steve, I'll go ahead and turn it over to you for our first presentation.
At the last meeting of the Left 2 Board, we indicated to you that the Department of Retirement Systems had mentioned to the Select Committee on Pension Policy that they were interested in pursuing some request legislation. And so they were starting to do some stakeholder outreach. And you indicated that you would like to have presentations on the same issues from the Department of Retirement Systems. And so we have today Seth Miller. Seth is the Assistant Director for Retirement Services. He works with us, has been working with us on LEF issues. The issues he's speaking about today apply to all the plans, including LEF. And with that, Seth has given this same presentation to the Select Committee on Pension Policy just yesterday. With that, I will turn it over to you, Mr. Miller.
Perfect. Thank you.
Right.
Welcome. Thanks for having me. Steve kind of gave everything I was planning on saying for an introduction, which is perfect. So this, over the last year, the department has considered a few items that we think would be beneficial for all the retirement systems and plans to adopt. And so I'm going to talk to you about two of the issues, hopefully relatively briefly. But if you have any questions, please let me know. The first issue is regarding the payment a person receives in the month they pass away. And it's been longstanding practice within Washington State that payment is prorated based on the number of days a person is alive in the month. We have seen firsthand that this causes a great burden for families and estates in a time that is very difficult for them. In a lot of ways, it seems like the state is sending them to collections, asking for some money back that may have already been paid. We believe it would be beneficial if a full month was paid in the month a person passes away. So just for your reference, how the proration works, it's based on the number of days a person's alive in a month. So in June, if I'm a retiree and I pass away on the 10th of the month, June has 30 days, then the department would only pay out 1/3 of the normal pension payment for that person in that month. And I provided three quick just little graphics of what this looks like in our office. We have to finalize pension payments before the end of the month. So usually around the 25th of the month, we finalize those pension payments. And if we're notified ahead of that time, we have the ability to make that proration before the payment goes out. And I think what we've really found is this wasn't so much of an issue when people were receiving a paper check in the mail. It was obvious that check arrived, the person had passed away, they understood that check probably needed to get mailed back to DRS, or they didn't have an easy way to cash it. But as we've automated our lives, those are being directly deposited. Over 98% of our retirees are receiving direct deposit for their pension checks. And so they also have a lot of bill pays set up and things like that. So if we're notified of the death after we finalize those payments, then that payment goes out unprorated, and we have to collect back that overpayment. And that's where it really feels like we're sending the folks to collections for a relatively small amount of money, usually a couple $100s. And I just wanted to clarify, it's also possible that the person passes away after we have finalized those payments. They pass away on the 28th or 29th of a month. That payment still has to have some proration, and we're going to have to receive some of that back. So, as I mentioned, we believe this is a great burden to families and estates when they're trying to settle all their other things that are going on with the family in that situation. It can also interfere with insurance premiums if people are having insurance premiums deducted out of their retirement check, and then that proration causes it so they aren't able to make the full payment for their premium. their insurance could be canceled in the month they pass away. Usually they have some claims against that insurance, and it can cause even more of a headache for those members. So just for your general knowledge, as I mentioned, this is for, we make this proposal for all retirement systems. We currently are retiring approximately 1,000 people a month, and we're being notified that about 500 people a month are passing away. So this is going to be a continually growing problem as baby boomers retire, go through the retirement process, and eventually pass away. So that's really it for my presentation. One thing I did want to make sure to make clear is there would be a cost to this change. The department would be paying out a slightly larger amount over the course of a lifetime because we're going to make that full final payment. The state actuary has been working on what the cost will be to the systems. We're expecting a couple of basis points increase to contributions because of this change, but hopefully they'll be able to speak to that in a future meeting. So are there any questions regarding that? Yes, please.
There it is. So you talked about notifying, I don't know the process, and maybe that's the question I'm asking, is who notifies? And has there been any, where maybe the family's so devastated they don't know about it for 6 months?
Yeah,
So is there going to be a problem with that? And
Great question. I skipped over that. So we work with the Department of Health within Washington State and the Healthcare Authority to receive notifications of death. So we understand that DRS might not be the first thing on someone's mind when a loved one passes away. And what we're also talking about in this situation is only for the month a person passes away to make a full payment. If we're not notified for 6 or 8 months down the road, that's still an overpayment situation where we need to collect that money back. So we definitely want to avoid any sort of fraudulent situations that could be caused by this. So our draft legislation still provides the authority for the department to collect back those overpayments beyond the month the person passes away. Thank you for the clarification.
Thanks, Seth. So you anticipate that this will be DRS request legislation? I guess kind of also quasi question for Steve. So would we be endorsing this measure?
That's a good clarification. We are not requesting this legislation. We have proposed it to the select committee with their hope that they will sponsor legislation.
Yeah, I apologize.
No.
Using the term DRS request since they're a state agency request legislation is actually a term of art. Now, they've made the proposal to the select committee to see if the select committee will consider endorsing it. To the extent that the board wants to have the same thing apply to Left 2, we will keep you coordinated in terms of what's going on with these issues at DRS and the select committee. And theoretically, they could end up being joint request bills, SCPP, L2B request bills. That's happened in the past. It's also possible that the SCPP could do it and you guys not, or you guys do it and they not. Though that's happened in the past as well. But these are clearly policy issues that apply equally, if you will, to all the plans. We asked DRS to kind of look at the data and see is there any higher incidence or anything about Left 2 that applies differently. And right now, there doesn't seem to be on these two.
Mr. Chair. Thank you, Mr. Chairman. Just a quick thought, either one of you on this. You use the term policy, Steve, on this. Is this something that has a statutory construct that requires that you attempt to recover this, or can this be changed by policy within DRS?
It's a good question and something we have wrestled with. We believe we may have the authority to do this. It's not clearly defined, but it has been long-standing practice for the department, and actually even prior to the creation of the department, which is one of the reasons we would like it to be brought forward as a legislative change to make it clear that we are following what the law is. And also because it's going to likely cause a contribution rate increase. We're concerned that if we adjust a policy that causes a contribution rate increase, that might not be in good faith.
Understood.
I have a question.
Yeah.
So when the actuary figures out what the cost, will that be broken down by plan?
Yes,
Okay.
yes.
So it could cost different according to the plan, according to the demographics and.
It likely will. And what we asked this question a couple of years ago when we were trying to determine if we had the authority to do it. And what we saw was it did vary by system and plan.
Mr. Chair, yeah, maybe I missed this, but I was on the phone, so I was listening in, but
Yeah.
the 500 approximate people that pass away every month, out of that amount, how many people are we talking about that get caught up possibly in this type of situation?
So at any given point, we have about 300 people that we are in the process of trying to collect funds back from. And that's kind of a rotating, as we collect funds back, new people get added onto that list. So.
Sure. Just to follow up on that, you're talking about 300. Is that just for the last month that they're alive, or is that somebody that's been out 6 or 8 months and you have to go back and collect?
It's almost solely the last month of life.
Good. Thank you.
Any other questions for Seth? All right, thank you, sir.
Yeah, I can jump to the next one too.
All right.
So this one might be even quicker. And I know Jacob is providing a presentation later today regarding survivorship options. So some of this will be overlap, though they are separate issues. What we're talking about now is when a person is about to retire, they have, and they are a married member, any retired member, but we're specifically with this presentation talking about married members. They have the ability to select a survivorship option. They can provide an ongoing benefit for one other person for the rest of their life as well. And since Washington is a community property state, when these survivorship laws were written, the intent was that a spouse had to sign off on something if they were receiving less than what would normally be given in community property. But in application, it's caused some problems or some confusion we'd like to clarify. And I've got a chart and 2 slides that hopefully will make it crystal clear and we can be done with the presentation. But before that, we just need to make sure everybody has an understanding of what the survivorship options currently are. So a person, when they retire, they could take no survivorship option, and that's what you think of as the standard benefit, 2% times the number of years they work times their average final compensation. And then there are 3 different survivorship options they could take. They could have a 100% survivor option, a 50% survivor option, or a 2/3. If they take one of those survivor options, they're going to receive less while they're alive because they're providing a continuing benefit for someone else. So the next chart shows what that looks like. So I just created a scenario with a left 2 retiree who's going to receive a pension of $5,000 and they have a spouse of the same age. And so if they take the single life option, they're going to receive $5,000 a month for the rest of their life, but no benefit for a spouse after they pass away. So what you can see in this chart, hopefully, is that under current law, a spouse has to sign off if they are receiving the 100% survivorship option or the 2/3 survivorship option. But they don't have to sign off if they're receiving the 50% survivorship option. Right, okay, I saw one person look a little like, oh, that's silly. And it is. And this is the reaction that we get from members when we have to explain this to them. They look at this and say, why would I have to get my spouse's consent if I'm providing more than the community property option? And our proposal is that we tweak this law to make it clear that a spouse only has to provide consent if they are receiving less than the 50% option, so no benefit. So that's really it for the presentation. Just for your general reference, one of the reasons this is becoming more important is we're having more and more of our members apply online for retirement. Left 2 members are actually the most likely to apply for retirement online. If they apply for retirement online, the only piece they have to do at the end is they have to print out a piece of paper, give it to their spouse has to sign it, and then mail it into the department. We would like to eliminate that in some of these cases and be a little bit less burdensome for folks who are going through the retirement process. I should also mention that this doesn't impact accounts where a person has some sort of property order because of a divorce or something like that. It was something that came up in the select committee that I forgot to mention as well. That doesn't, this doesn't trump that. The court order would still, if that's been decided on how an account needs to be split or who needs to sign off on what, that will still trump. So, are there questions regarding this issue?
Go ahead, Pat.
This is an issue that came up before too, Seth, or I've talked about it, is that once you make that choice, but it's there. There's no changing it.
Correct.
It has, and we've had problems with that people, once they go in, they think they know what they're going to get, and it turns out, once they start getting their check, they figured out they picked the wrong option. And then they come back, and unless something was, relayed to them that was different, there is no way that they can go back and change that option. And we've had some issues recently. Would there be any pushback from DRS if all of a sudden these people were, if the retirees were given like a 30 or 60-day option to review what they've done?
I know that's what Jacob's presentation is going to be about in a couple of minutes, so I'll let him speak specifically to the issues surrounding options after a person retires.
Would you guys have a problem with it?
It would be administratively burdensome, for certain. And the one thing I can speak to for sure, just in interaction with a number of folks who go through the retirement process, is that there is always some sense of buyer's remorse, where you make this big life decision and you're not 100% certain if you've made the right decision. And I think that can be challenging. Where you draw those lines. I mean, you eventually have to draw a line somewhere, and whenever you cross that line, people are going to feel like they may have made the wrong choice and want a second bite at the apple.
Okay, thank you.
Question for you, Seth.
Yeah.
In the beginning, you mentioned kind of the marital laws in the state of Washington, obvious common law state. Does this conflict with any of that, or would you say this is more in line?
I would say it's more in line. We've worked with the Attorney General to ensure that this would pass muster with them as well, and everyone believes it's what is currently being required is much more burdensome and not in line with the way the law should be written.
Thank you. Any other questions for Seth? Yes, Senator Warnick.
It's not necessarily a question, but I think more of a comment, and it was regarding the change or requested changes in buyer's remorse. Seems like the retirement plans that my husband and I have, they're not necessarily state, but we're constantly being asked to update our signatures on that, our beneficiaries on those, because it does become stale. So I have a problem with saying it's too burdensome, and at least that's the word I heard you say. So I think we really need to look at trying to make it easier for the retirees and review it at least every year or two.
Oh,
because I'm doing that all the time on private ones. So.
Absolutely, and I think maybe I didn't clarify clearly enough that the survivorship option is a once in a lifetime decision, whereas adding, and this is where it may be a technical DRS confusion. Having a beneficiary on your account is something that you do prior to retirement, and should be updated, and we absolutely would want someone to. And our intent with removing the spousal consent is really to try to reduce some of that burden, so a person doesn't have to fill out as much paperwork as they might normally or currently do.
More questions for Seth?
Okay, and again, we will keep you coordinated or keep you informed in terms of how the SCPP is handling both these issues. DRS had a third issue that they brought to the SCPP, but it has to do with purchase of annuity, which already exists in Left 2. So that one didn't apply to Left 2. Now, at the last meeting, I introduced our newest team member to you, but this is your first chance to hear from him directly. Jacob has been working in the pension arena for many years, mostly at the Department of Retirement Systems. These are his first couple of presentations. The first one up, what we're calling career change alternatives. The board over the last 5 years has heard a number of different issues related to Left 2 members retiring and returning to work, whether they're changing careers or whether they want to come back to work in the exact same career. Last interim, the board asked us to bring this issue back to you this interim with sort of an update on what those various policy questions are that are out there surrounding retired left members working after retirement. And that is that presentation that you asked for last year. So with that, I'll turn it over to Jacob and let him explain to you all the ins and outs.
Okay. Chair, members of the board, for the record, my name is Jacob White, Senior Policy and Research Manager for the Left 2 Board. This morning I'll be providing you an initial briefing on career change alternatives. Since Steve gave a good intro to, since the passage of the board's 2005 career change law, multiple issues have surfaced over the years related to employers' interest in hiring left retirees into left positions. This presentation will provide information on the history of the current Left 2 career change law, issues that occurred from employers attempting to fill law enforcement and police officer or law enforcement and firefighter positions with Left 2 retirees, and then the continued and evolving interest in hiring retirees into left positions. Prior to 2005, the Left 2 retirees could not return to work into a DRS-covered position without having their pension benefit stopped. In 2005, the Left 2 Board researched this, proposed recommended legislation, which was passed, and that legislation is referred to as the Career Change Law. Under that Career Change Law, there are two options that Left 2 retirees can take. They can choose to return to work in a non-left position, DRS-covered non-left position, and choose to either continue to receive their Left 2 pension and be prohibited from entering a new pension system, whether it be PERS, TERS, SERS, or they can choose to have their pension payment suspended and start earning another pension in one of the other DRS-covered plans. So DRS provided me with some data on what's happened since that law was passed and how much it's been utilized and how it's been utilized. And so since 2005, 581 retirees have used the career change law. As you can see, the vast majority opted to continue to receive their pension check and not join another pension system. However, there have been 10 that opted into membership in a new system, 7 in PERS, 1 in SERS, 1 in PSERS, and 1 in TERS. And then outside of the career change law, there were 55 left retirees who re-entered left membership, meaning that their pension was stopped and they began once again paying contributions and earning service credit. And then when they re-retired, the pension was recalculated from there. So what was the intent of the board's career change law? The board intended to facilitate members transitioning from physically demanding left positions into another career, thus career change in the title of the law. And it recognized that LEF members had a lot to give to public employers, that they could continue to utilize their skills and knowledge while also serving the public, which there was a strong interest in. The board did not intend to enable LEF 2 retirees to return to work as law enforcement or firefighters while continuing to receive their LEF 2 pension. So concerns have been brought to the board in the past where employers, at least some of these have come, where employers have narrowly crafted positions with the alleged intent of avoiding membership in LEF 2, so they could hire a LEF 2 retiree. That LEF 2 retiree could continue to receive their pension and work for the employer, doing work that was traditionally a LEF position. And some of those situations have been in the newspapers over the years. So how have employers attempted to fill those traditionally LEF eligible positions with LEF retirees? It's really come at the intersection of the career change law and the long-standing definitions of what it is to be a law enforcement officer or firefighter. And so I'm not going to read you the full definitions, but just draw your attention to the terms full-time and fully compensated. Those are two areas where this has really come into play. These definitions, it's my understanding, were originally drafted to set a high bar for what it is to be in LEF, to separate volunteer firefighters or limited authority law enforcement officers from LEF members. But the career change law created an incentive for employers and members to make positions, to find ways to make positions PERS eligible, therefore allowing retirees to continue to collect their pension check. So what does fully compensated and full-time mean? Those are not defined in the law, so they've been defined through with DRS through rulemaking. Fully compensated is now defined as normally expected to earn a basic monthly salary no less than 160 times the state minimum hourly wage, which is currently $1,840 per month. And that's a newer definition, so I'm going to talk about some of the past issues briefly, and a lot of those are no longer occurring since this definition was updated a few years ago. And then a more long-standing definition is for full-time, and that's 160 or more hours per month. And once again, if a position doesn't meet those definitions, then it would likely be a PERS eligible position or another state system. Yeah, some examples of how this issue has come up. Fully compensated, one that I'm aware of was a LEF member before retiring made $120,000 a year as a chief in a larger district. They retire, they go to work for a smaller district, and they're being paid $80,000. And then the argument is that they are not being fully compensated because their market value was $120,000. So those are some, and there was other ways in which people tried to kind of get around that definition, which is why DRS updated and set the bar a little lower for what it means to be fully compensated and drew a bright line. Full-time. Some examples of how that's come up is, so the definition was 160 hours. One example that was in the newspapers was a chief working 159 hours a week, a police chief. And so DRS ended up auditing that and finding that he was not actually drawing the line at 159, that he was occasionally going over 160. And so that position was found to be LEF eligible. But in another instance, also one that made the news, a fire chief had a contract to work 140 hours a month, and the DRS audited that and found he was actually working 140 hours, or at least less than 160, and so that was a PERS position and not LEF eligible, so the retiree could collect their check. And then another area where this issue has come out that's separate from that definition of the LEF definition, and this is an issue that impacts all, or at least in the past has impacted all the state pension systems, is employers classifying positions as independent contractors and not employees. And so this came to light in 2014, and DRS conducted a review of independent contractors across systems and plans and across the state, and found instances in LEF and other systems and plans. And since then, I'm not aware of any issues that have come up involving at least LEF employees that were misclassified as independent contractors instead of employees. And then when these issues were in the news and in 2014, the board actually recommended a bill that sought to prevent these exact types of situations from occurring. They recommended it to the legislature. It ended up not passing, and then since then, the board has not recommended legislation, although you have heard presentations like this almost every year. And so there continues to be interest in hiring retirees into LEF positions. Some employers are struggling to fill LEF positions and believe retired LEF members, the existing pool of LEF retirees could help ease those shortages. There are approximately 4,200 LEF 2 retirees. 1,750 of them have retired in the last 3 years, and 1,297 of them are under the age of 60. And this wave of retirees is going to continue. There's 26% of LEF 2 members are currently eligible to walk out the door and retire. This is an issue not just in LEF, it's been an issue in all systems and plans as the baby boomers retire. And even though I think LEF must be about the end of that baby boomer wave, which my favorite name I heard last week was the silver tsunami. I like that image. The legislature has set a precedent of utilizing retirees, of easing the return to work restrictions in other systems and plans. And the one area, most recent area of that was with substitute teachers. And that was a couple of years ago. They passed a bill easing some of what's referred to as the 2008 IRF restrictions, allowing teachers to return to help out as substitute teachers. And that was very limited in scope to just deal with this immediate shortage, so it expires in a couple of years. And then Senator Vandeweghe submitted a request to the board that you reviewed last month, and in that he had a similar issue he was raising regarding shortages of LEF employees in rural areas. And so he had a very narrow request that he thought that he recommended the board look at, and that was that LEF retirees could return to work outside the county they retired from, be rehired for a max of 2 years, with a minimum salary of $3,000 and a maximum salary of $4,000 a month. And so he went with a very narrow proposal there, which was kind of reminiscent of what the legislature looked at with the substitute teacher shortage. So that wraps up my first presentation. Any questions?
Representative Berkowitz?
Thanks, Mr. Chair. What kind of positions were they hearing about that were not being filled?
It sounded like line positions. Yeah.
Senator Warning?
Thank you. So you gave us the figure of 26% are retirement age. Can you tell me the percentage of new hires within, say, the last year or 6 months? I don't know if you keep track of that, but I'm just wondering, are we filling enough?
Yeah, kind of how many people are leaving and how many are coming.
Right.
I don't have that top of my head, but I'm sure we have that, and I could get it for you. Okay.
Any other questions for Jacob on this presentation? All right.
All right. Next up, Jacob again. And this is the first presentation that the board has had on this topic. It's the issue that you raised, Pat, a couple of meetings ago, and the board wanted to hear some background about what this issue is regarding survivor option elections. And so this is the first time this issue has been before the LEF 2 board. As Seth mentioned earlier, as a policy issue, this is one that could apply equally to all the plans, not just LEF 2. But with that, I'll turn it over to Jacob to give us the update.
Okay, got the first one out of the way, ready for the second one. Chair, members of the board, for the record, my name is Jacob White, Senior Policy and Research Manager with the Left 2 Board. As Steve said, this will be your initial briefing on the survivor option election. The issue here that was raised is that it may be considered unfair to have a member make a irrevocable retirement election for a survivor option without knowing exactly what their pension payment will be. The presentation will cover background on survivor options, retirement benefit estimate accuracy, and anti-selection risk of survivor options. So as Seth did a good job explaining, Left 2 members may elect to take a reduction in their monthly benefit in order to leave an ongoing benefit to a survivor. Typically, that is a spouse, but you can actually select anyone else to leave a survivor benefit for. The survivor will receive the ongoing benefit for their lifetime. The reduction that the member takes to leave that benefit is based on the increased probability of the pension system making those ongoing payments. So the intent is that the same amount of money be paid over 2 lifetimes that would have been paid over 1 lifetime. The way that that amount is the amount of reduction is determined, OSA recommends administrative factors, which determine how much the benefit is reduced based on the age difference between the member and their survivor. And then the Left 2 Board adopts those administrative factors that OSA recommends. As Seth walked through, there are 4 survivor options: single life, joint, and 100% survivor, where the survivor receives the same benefit that the member did. And then the joint and 50% survivor, and the joint and 2/3 survivor. So as Steve said, this impacts could potentially impact more than Left 2. Plans 1, 2, and 3 in PERS, SERS, TERS, and I left out PSERS and State Patrol all have the same survivor options as Left 2. The one plan that is different is Left 1, which has an automatic joint and 100% survivor benefit that is not optional. It is built into the plan that a spouse automatically receives a 100% survivor benefit with no reduction to the member's benefit. So I want to just walk through an example, just like Seth did. The member, in this example, the member is age 53, the spouse is 50, their final average salary is $8,000 a month with 20 years of service credit, which means their monthly pension benefit would be $3,200. And so here we see what that looks like over a single life, over the joint in 100, over the joint in 50, and the joint and 2/3 survivor benefit. Again, the intent is for that amount paid over 2 lives to be equal to the amount that would have been paid over 1 life. So we've used the word irrevocable, but with like everything with the pension systems, it's a little more complicated than that. There are some exceptions. So a retiree's survivor option choice is irrevocable unless, except in the following situations. They designate someone other than their spouse to receive the survivor benefit. They can choose to remove that person, and then their benefit pops up to the single life amount, and they do not get refunded any of the prior reduction they took. If a member marries or remarries after retirement, they have a window after 1 year of marriage and before 2 years of marriage to name a survivor and take a reduction in their benefit. And then, not really changing your option, but if you choose a survivor option and the survivor dies before the member, the benefit is referred to as popping up. It pops up back to the single life amount. And once again, the member does not get refunded the amount of reduction they took, but they do get the single life benefit moving forward. And then lastly, a member can return to membership. So if you return to membership, you start paying contributions again and earning service credit, and you re-retire, you get to make all of these selections again.
Jacob,
Yeah.
is that for any membership or just specifically left membership?
Any membership.
One of the things on that last slide where it says you return to work, I
Yes.
think the question would be what is the term that they have to return to work before they can retire and change the option?
I believe as long as you return to work and your pension is stopped, so I think 1 month of not receiving your pension would, looking at Steve to correct me here, but
I would check with DRS.
Yeah,
Yeah.
it's different for some of the plans, and there is a more lengthy requirement, I think, in some of the plans, maybe to prevent members from returning to work, but we can get you the exact time frame for LEF.
Because that's what also created the problem,
Yeah,
gentlemen, so,
yeah.
okay, thanks.
okay, so the next part is how does a member know what their benefit will be before they make this irrevocable election? So DRS encourages members to request at least one benefit estimate within a year of retirement. To do that benefit estimate, DRS gets information from the member about what their expected retirement date is and what survivor options they would like to select. They can get as many estimates as they want with multiple options. And then the estimate takes into account the expected final average salary. I should say the estimate does not include any withholdings the member will take, so it is, and then how accurate are those benefits? So DRS provided us with some data. This is a metric that they track as part of their quarterly target review, which you'll hear more about when they present later this year. But as you can see here, 1% of what this chart does is comparing left to all systems to see that it's pretty comparable to how accurate the estimates are. Just over 1% of estimates are within 3% of the actual benefit paid. And then the vast majority, about 93%, are within 3 to 10% of the actual benefit paid. And 6% there's more than a 10% difference between into what the benefit actually is.
Go ahead, Mark.
So when you're going through the benefit estimates, so you can do a sort of a self-serve benefit estimate option on the DRS website where you plug in the information that you have, and then that will return an estimate to you. Then when you're getting ready to retire, the DRS will actually audit your reported earnings and the other factors that you put in there. So does this, is that chart reflect people's self-serve options, or is it after the DRS audits your?
I believe it's the official estimate from DRS.
Okay.
I'm going to look back to Seth. Yeah.
'Cause there's a
Yes.
lot of the other ones. People
Yes.
do their own all the time.
Yes,
You can
no,
do
it's-
those all you want, but I think there's a limit on the official estimates that DRS will provide you according to your timeline at retirement.
Okay.
So anyway, that was my question. Thank
Okay.
you.
So why are those estimates different than the actual benefits, and especially why those ones that are more than 10% different? So the ones that are more than 10% different, the reason the most common reason for that is that the member ends up selecting a different survivor option than they got an estimate for, or the member retires at a different date than they expected. For the other ones that are smaller differences, the most common differences are that changes to final average salary, which can be getting more pay than you expected and getting good news with your benefit, or less than you were expecting, or employer errors in reportable compensation. And then another one, this was my personal favorite because I think we've all been there, incorrect birth date for survivor. So getting your spouse's or survivor's birth date wrong on your estimate could lead to a difference. And it's apparently a common one. So what's the policy reason behind a member, behind this being an irrevocable choice and the member not being able to change their mind? It's an increased risk of anti-selection. And so the actuary definition for that is anti-selection is the tendency of a person to recognize his or her health status in selecting the option under a retirement system which is most favorable to him or herself. And so what an example of that is, a member knows that they're not taking very good care of themselves, they're a smoker, the family doesn't live long, and they know their spouse is healthy and their family lives a long time. That would could potentially increase the incentive for them to choose to leave a survivor benefit. So the risk of anti-selection are currently mitigated through having the survivor option election at the time of retirement, and then I did mention for post-retirement marriages, there's that 1 year to 2 years that you have to name the person a new survivor. And that's for the same reasons. That's to prevent increased anti-selection risk. And so what it comes down to is the more opportunity a member has to change that election, the more likely anti-selection will impact left 2. So you choose a single life, you find out you have cancer, you have more incentive to change that, which then goes back to that point of the purpose of the survivor benefit being reduced is to collect over 2 lifetimes what would have been paid over 1, and it makes it more difficult to do that. So how could anti-selection impact left 2? So if anti-selection risk increase, it could impact left 2 through increased contribution rates. It's probably the most likely scenario. It could also result in less favorable administrative factors, which means you'd have to take a greater reduction in your survivor benefit in your benefit to leave a survivor benefit. And then if there was a change to it, it could result in intergenerational inequity. That wraps up that. Any questions?
Senator Warnick?
Can you remind me, we recently had a bill that went through for a survivor remarriage. Can you remind me what that bill covered?
So I believe that one was for left 1 members, and it was
just left 1? Is that right? Okay.
Yeah, left 1, as Jacob mentioned, they have a different survivor option. So they have a spouse at the time of marriage. That spouse gets the joint and 100% benefit, no reduction to the member's retirement. They did not have an option to allow for a post-retirement marriage to be re-added the same way that the other plans did. And there was some issues also about with respect to that particular legislation. The person that was bringing it forward thought that they hadn't been notified or hadn't had the full opportunity to make the selection, and so they were looking for increased opportunities, but just for left 1.
Well, the bill that I was thinking of, though, had to do with the surviving spouse remarrying and possibly
The
losing the retirement benefits.
Oh,
Was
okay.
that?
Yes. Now,
okay.
that's
Okay.
a left 2 bill. It was a left 2 board recommended bill that then got amended in the legislative process. In LNI, currently, you get a survivor benefit as well for any worker that's killed in the course of employment. That benefit stops if the spouse of the deceased worker remarries. There was a left 2 board proposal to allow the surviving spouses of left 2 members who were killed in the line of duty to remarry without losing their LNI benefit. What the legislature ended up doing in that bill was saying that their LNI benefit will still stop, but they will get a benefit now paid for out of left 2 that's sort of equal to it. So from the surviving spouse's perspective, even though they remarry They continue to receive the payment that they had been. It just where the money comes from changes. And there's been a couple of remarriages since that bill from 1977 to the passage of the bill. I think out of all the surviving left two spouses, only one had ever remarried. But since the bill passed, now that financial disincentive to remarry, with the removal of that, there's been at least a handful that have remarried. Sorry about that, misunderstood your question.
Go ahead, Pat.
Thank you, Mr. Chair. Jacob, your last slide, could you bring that back up? I would like to bring up some issues or concerns. On what we're talking about, I'm not really fully educated on what happened to this the person that we're talking about recently. That they got an estimate. They thought they picked the right one. Turns out they did not pick the right one, and in doing so, it wasn't with the 100%. It wasn't with the 50%. They were in limbo between the 50% and the 66.67%, and that was the option that they pulled. And in doing so, once they got their check and they saw what it was, is they believed they had received good information from DRS, misunderstood, kind of like blind man feeling an elephant. You start at one end and the other, and you think you know what you're talking about until all of a sudden the elephant shows itself. But they were locked in, and thank you for DRS reviewing the file. They actually were able to mitigate that situation for the gentleman. But one of the things that I heard you say is, and I've understood it for a long time, is that the way the retirement system works, or the pension, is that whether I pick the 100%, the 50, or the 66.67, it is supposed to pay out what the single survivor should have done. So when I see that it impacts left two, because it's going to increase contribution rates, if it is actually managed that no matter which one you pick, it is supposed to end up at the total, I don't know how much it would affect the contribution rate. The other thing that I see is the idea that if given a 30-day or a 60-day window to make that determination, once you start getting that check, that's when you know whether you made the right choice or not. It's not like all of a sudden and if the person finds out they got cancer in that 60 days, that's only 2 months of a paycheck that would be changed. So I would believe that the cost would be de minimis, if anything, in that time period. But it does give the person a chance to make sure they made the right option. Because when you are in there, because I just retired, when I'm in there talking to DRS, I'm listening to the person. I have my spouse sitting next to me, and we are listening, saying, okay, this is the right one. For me, it was easy, because my wife told me what I was going to do. And it worked like a charm. And so, but in some cases, there's a lot of action going on. There's trepidation. And I'm thinking, and so I guess what I would like, and maybe if we could, is, what would be a problem with giving them a 30-day window? And I heard DRS say it's burdensome. My question would be, how many requests do they get, in the last 5 years to have their benefit changed within the first 30 to 60 days? Do they wait 6 months? Do they wait whatever? So that would help me on if I would, really want to see this, because I do know there's people out there that have made the wrong change, not for any financial gain. They just thought they were picking the right one at the right time, and then it is irrevocable. And unless there's a mistake made or some outstanding circumstances, that it can be changed. And so if you wouldn't mind, if that's okay with Steve, that...
Yeah, at your next meeting in July, all of the proposals that you've heard in May and June will be brought back to you to decide which ones you want us to continue to work on. And the types of questions that you just asked, Pat, are exactly the types of things
Thank you.
that we'd be looking into on this issue if it moves forward.
Yeah, and I wanted to add that this slide wasn't saying that if you had a 30-day window that it would increase contribution rates and
Oh, no,
we
no,
would
no,
have
no,
to
I-
figure
that's-
that out. Just
I was
yeah.
thinking ahead,
Okay.
because that's the idea. It's a great presentation. I'm glad you gave it, because it helps me understand what we're trying to do. So thank you, Jacob.
Okay.
Any other questions for Jacob?
Thank you.
Thank you, sir.
Okay. The next presentation is actually mine, and I think I'm going to move around here to the front. All right, let's see if I can do this. Last session, there was legislation proposed that would have changed presumptions in workers' comp statute for certain medical conditions, would have created a presumption that some medical conditions are duty-related, both for police officers and firefighters. The bill did not pass, but it did go quite a ways through the legislative process, and during the legislative debate around this, it raised a number of questions that I wanted to bring to your attention today, and so that you could understand them and ask questions about them, because there is a spillover to left 2. If a medical condition is considered duty-related, and it ends up, for L&I purposes, and it ends up resulting in the member going out on a disability retirement or dying, then that member's benefit would be considered duty-related as well. So if a cancer is fatal, the worker's estate and family would receive L&I benefits, but they would also receive duty-related left to death benefits. If a member's illness is considered in the course of employment for workers' comp and it ends up disabling the worker, they would not only get L&I benefits, but they would get a duty-related disability retirement from left 2. Right now, under current law, there are a number of different medical conditions that are presumed to be work-related. That doesn't mean that they are work-related. There's just a presumption there. So, for instance, a cancer is a classic example. Medically, it's often impossible to say at the exact moment or what sparked at that when that cancer first appeared in the person's body. But if and so even if the burden of proof is fairly modest, just a 51%, if you have no evidence, you can't meet the 51% burden. You're always going to be at best 50-50. So the legislature years ago created presumptions for us, for firefighters related to certain diseases where there was medical evidence that these conditions were occurring among firefighters at a much higher rate than the general public. So, for instance, if there was a cancer that was showing up among firefighters 6 times more often than the general public, the legislature believed, all right, in that situation, we're willing to kind of presume that it probably was work-related, unless there's conditions that show that it wasn't. You were a smoker, you had family history, et cetera. I'll talk about some of those. Those presumptions, since the creation of those presumptions, there's been a number of different issues that have kind of come up at different times. One is should other cancers be added to the list as more medical information comes about? Should some of the cancers that were originally added be removed from the list as more medical information comes out? There are no presumptions for law enforcement officers, and so some, like, for instance, the heart attack presumption for firefighters. Law enforcement officers often face the exact same types of strenuous working conditions, events that require an unusual exertion that are covered for firefighters, but they're not covered for law enforcement. The presumption doesn't apply. Some EMTs are covered under the presumption, and some are not. So there's always been this question about why this group's in and not. And then there's also federal law that provides death and disability benefits for certain work-related incidents, the Public Safety Officers Benefit Program. And that does apply nationwide, including Washington. Under federal law, there is a heart attack presumption for law enforcement officers, or a heart attack, or a benefit for heart attack, and a presumption that certain heart attacks which occur within limited circumstances, they're going to presume that those were duty related. There was legislation proposed by the Left Board years ago to create a heart attack presumption for law enforcement officers. It was following the death of a law enforcement officer from heart attack while he was on duty. He was in his patrol car responding to an officer-involved shooting call, but he was by himself in the car. There were no witnesses to see what caused the heart attack, and initially the determination from L&I was, well, it's 50-50. We don't know what caused it, so no determination that it was in the course of employment. During the legislative process and during the review process that was going on at the same time at L&I, they eventually did determine that that heart attack was in the course of employment, which meant it was also duty related for Left 2. But that bill brought up a lot of questions about the presumption and about the cost and setting precedent for other plans. And there have been a number of bills since then around this issue. Last year, engrossed substitute Senate Bill 6213. So this bill started in the Senate, was amended in the Senate, passed out of the Senate, ended up dying in the House. The bill had kind of addressed several of these issues all at the same time. So specifically what the bill did was add some emergency technicians and public employee fire investigators to the list of covered positions. It did add some additional cancers to the presumption, and it created a presumption for heart problems and infectious diseases for law enforcement officers. So it got at some of these ongoing policy issues, several of them, all in the same bill. During the course of the bill, another issue that came up, and let me just move to the next slide. These 5 issues kind of are the ones that tend to come up the most often. Law enforcement officers. Should there be a presumption for them related to the type, their employment demands that are similar or identical to the demands that are on firefighters that led to the creation of the firefighter presumption? Emergency medical technicians, why are some in and some aren't? What's the distinction, or is the current distinction appropriate? Strokes, the original version of the bill from last year included strokes in the presumption. And that's been an interesting question. It came up during the heart attack bill that the Left Board proposed initially, because medically the same condition that causes a heart attack causes a stroke. It's just, in the case of a heart attack, the blood clot ends up in your heart, and in a stroke, it ends up in your brain. But the same underlying causality is identical. However, strokes are not covered under a presumption currently for firefighters or law enforcement. And then infectious diseases. In the course of employment right now, and the type of work that they do, particularly EMTs, they have frequent contact with people in the public, bodily fluids, potentially infectious diseases, and so you do see a higher incidence among police officers and firefighters of certain related diseases, whether it's hepatitis C or other infectious diseases that are transmitted by bloodborne pathogens. And then cancer. There's ongoing medical studies all the time. There's several ongoing right now regarding links between certain types of cancers and employment. In particular, one of the issues that the board has found in the past is that the studies that are being done on a national level really tend to focus on firefighters. In Washington, police officers and firefighters are in the same pension plan. That's not always the case in other states. And the study of cancers related to firefighters, there's probably 6 or 7 or 8 studies ongoing related to firefighters for every one ongoing related to law enforcement officers. And the data is sometimes different from one group to the other. When the original cancer presumption bill was passed, they didn't put anything in the statute that specifically said, here's the threshold. If it's 4 times more likely in firefighters than it is in the general public, then we'll approve it. Or if it's 6 times, or if it's 2 times. And so that's been one of the questions that has come up. There was a sort of a general bar that was used by L&I back at the time that it was created. It was set up by the original bill was a result of a task force, including L&I. And so the question since then has been, well, was that the appropriate threshold, or should it be higher, or should it be lower? And what happens if things change? You get safety equipment to deal with, for instance, originally there was a belief that most of the source of cancer-causing exposures for firefighters was the smoke that they were breathing. And that certainly was a source of exposure. Now you get improved breathing apparatus, and that cuts down on the exposures. So now, should that affect the presumption or not? Similarly, though, there's been now medical studies that have come on and say, well, it's not just the smoke, it's actually the diesel fumes. So then you create procedures to avoid exposure to diesel fumes. And many of the cancer-causing pathogens, it's skin exposures. And so now you have to go back and work on the bunker gear or the equipment. Those are the types of, so these exposures and the scientific knowledge around them is a bit of a moving target. And that's something that the legislature has wrestled with over the years, including the year 2018. And so this is a topic that the Left 2 Board has discussed in the past, has made recommendations on in the past, to the extent that the board, I bring it up with the idea that you could consider in July whether this is one of the things where it would be helpful for the board and stakeholders in the legislature to have us do some policy review of some of this stuff before session, whether you end up making a recommendation on it or not. With that, though, I'd be happy to answer questions, and the idea about moving forward, that's something you'll talk about next month with respect to all of the different benefit-related topics, if you will. But this crossover between L&I and duty-related death and disability benefits has been a challenging one in the past. If the board's proposed something, people, well, that's an L&I law, for instance, like the remarriage prohibition or the presumptions. And it's, yes, but it also affects left two benefits as well. So there's, anytime you've got a little bit of a crossover between agency policy responsibility, there's there's tension there, particularly in terms of if there's proposals there. But with that, I'd be happy to answer any questions about the bill last session and or prior work by the Left 2 board, if you have any.
Setting aside the political viability of either one of these bills being presented, 2333 as a companion, or 1655, which we made headway with in the House last session, institutionally or structurally, fire has always had a sound statistical base for the requests out there. They've done the work, created the science to justify their positions. Cops, not so much so. Are you seeing any sort of an equalization or anything coming on board or about to come on board from the law enforcement side here that would justify some sort of an equal position?
There are a number of medical studies out there with respect to cancer and law enforcement officers. But again, not nearly the volume of studies that there are out there for firefighters. And it may be a perception, right or wrong, that the law enforcement officers don't have the same exposure risk to cancer-causing pathogens that firefighters do. Again, as the understanding of what cancer-causing pathogens are, that may be changing. But to the extent that the studies were out there, there didn't seem to be, with respect to law enforcement officers, the same kind of spike in cancer rates compared to the general public. But where you did see clear deviation from the norms with general public had to do with some of the infectious diseases. And as you're well aware, there is an increased, because of your line of work, and there are a number of exposures to people who have infectious diseases, and that could account for the spike in incidences. And then the other area has to do with the heart attack and stroke, particularly after 9/11. One of the things that happened right after the events of that day, so you've got all the responses going on and the craziness going on during that 24, 48-hour period, there was an enormous spike in heart attack deaths within the next 48 hours amongst law enforcement officers and firefighters. And at that time, because of the presumption, there was no presumption, all of the claims were denied at the federal level. You couldn't prove what causes that piece of material to break loose in that blood vessel at that time beyond a reasonable doubt. And and for many of them, the initial exertion may be what causes the event, but it doesn't really manifest until that clot sticks somewhere, and that could be 24 to 48 hours later. So, for instance, a number of the heart attack deaths in New York actually happened when they finally got off shift and they went home and they went to bed, and then they never woke up. So that was the underlying basis for the federal presumption that if you, for both police and fire, that if you have an unusual exertion in your job and you have suffer a heart attack or stroke within a narrow window of time after that unusual exertion, then we'll presume that it was that unusual exertion that caused the heart attack and not just coincidence. For instance, in the one case that we had in here in Washington at the time of the bill, I mentioned that the officer was responding to a officer-involved shooting call, an extraordinarily stressful, if not the most stressful type of call that you can get. At that time in the city of Federal Way, in the entire history of the department, there had been 2 officer-involved shooting calls, and there had been 1 heart attack that had occurred on shift. So the idea that the 1 heart attack in the entire history of the department happened coincidentally during one of the extraordinarily rare but highly stressful calls, that I think influenced L&I's decision to say, no, that's not, in all likelihood, that's just not a coincidence. We're willing to reverse our initial determination and make the finding that it was in the course of employment. The presumption sort of takes that from being a case-by-case determination and applies it blanket. The initial left to board proposal from years ago took the federal language and kind of matched it into the state so that there would be a state presumption that would match the federal presumption. But again, that bill didn't pass. There were concerns about the cost, and there were concerns about that it would create a precedent for other unusually stressful or jobs that required unusual exertion that had nothing to do with law enforcement or firefighting. Did that fully answer? Okay. And on the cancer thing, we track all the ongoing studies related to law enforcement every year. Tim's got a database of all the ongoing studies, and we try to stay on top of, is anything emerging in that area? But those studies often take, some of them take more than 10 years, and so most of them that we looked at back at the time the bill was first proposed that were ongoing then, they're still ongoing now.
More of a comment than a question, but kind of segues off of Representative Hawley's question, is that with the presumptive illness for the firefighters is presumed, and there's a process for that. For the law enforcement side and the officer that Steve's referring to, that individual had to fight for those rights because there was not the presumptive issue there. So that's really one of the main differences when it comes to the line of duty illnesses or deaths for law enforcement. Just to kind of segue off of that. Any other questions for Steve? All right. Thanks, sir.
All right. Back to the regular presenting team. We've got several presentations now coming up from Ryan. The first one has to do with funding method options. This is a follow-up to a discussion that started last month, really helping, the purpose of these presentations is to help you understand the method that's currently being used to determine the contribution rates for your plan. You'll be voting on contribution rate options next month, and so understanding the underlying method that's used to do that, is part of this. And then out of, as it turns out, you'll find out there are methods that are prescribed in statute. There are methods that are, that the board has elected to use within your authority to do so. And that's created some challenges for the actuary's office, and it's created some challenges in communicating what you have been doing and why. So one of the issues that you'll be considering this interim is, do you want to formalize your actuarial cost method, your funding policy that underlies some of the rate decisions that you've been making? With that, this is the second kind of the follow-up on that. And we've got the actuary's office here to assist in answering any questions that come up. With that, though, I'll turn it over to you.
Thanks, Steve. Mr. Chair, for the record, Ryan Frost. Before we start, I just wanted to thank Steve and Lisa for covering for me last month when I had something come up last minute, some family stuff. So they
How's that issue doing?
that issue is awake a lot. But I just wanted to thank them for covering for me, doing a great job. So, as Steve mentioned, the issue here is that there's a variety of funding methods used to estimate the cost of future benefits, and it's up to the board to decide which method aligns best with their funding goals. By way of background, the aggregate cost method is the statutory funding method for all the plans, including LEF 2. However, the board has used a temporary funding method for much of its history. When the Office of the State Actuary presents to the board, they'll point to the aggregate method as being the long-term method or the statutory method for funding the plan. Some more background is that the board was created right after a market crash at a time when rates were out of bound with what the expected long-term cost of the plan was. Therefore, the board adopted a stair-step annual rate increase to tie them into the normal cost of the plan, and that'll be shown in a chart later, that step up. And then in 2008, right before another market crash, the board had the foresight to adopt a temporary funding method which set the rates at 100% of the long-term expected cost of the plan. So a bit of background on funding policy. A funding policy is very important to the success of a pension plan because these policies help address the plan's affordability, the risk of the plan, rate stability, and rate adequacy. While the funding method is the underlying rate calculation, any funding policies the board adopts is layered on top of that. And Left Plan 2 has stated the following as goals in the funding policy, and I'll talk about each of these a little bit. But the list is here: stable contribution rates, full funding on an ongoing basis, smoothing investment returns, an asset value corridor, setting minimum contribution rates, as well as adopting multi-year rate plans. Then a bit of an overview on funding method. The choice of a funding method is a core issue for a pension plan because the funding method determines the way the cost of the plan will be financed over time in much the same way that the choice of a style of mortgage determines the way in which the cost of a house is financed over time. All standard funding methods will accomplish the same goal of completely funding the cost of the plan, just like a fixed rate mortgage or adjustable rate mortgage can be used to pay for a house. And this report will examine two of the standard pension funding methods used by Left Plan 2 since its inception, the aggregate funding method and the entry age normal cost method. And then I'll also examine the variation of those funding methods that the Left 2 board has chosen to use when setting their contribution rates. To get to the first of the funding goals is stable contribution rates. Stable rates results in a more predictable budget obligations for the plan members, local government employers, and the state, which helps them prepare to meet their future funding obligations. The board has adopted contribution rate stability as one of the key elements of the board's strategic plan for Left Plan 2, and you've adopted that since the board was created. And then there's a number of policies which have been adopted in order to moderate these short-term swings in contribution rates. And I'll get into each of those also here, starting with this next slide, which would be smoothing the investment returns. Left Plan 2 has a 7.4% return assumption. However, on a year-by-year basis, investment return is almost certain to be higher or lower than that 7.4%, which results in a gain or a loss compared to that earnings expectation. So what pensions commonly do is they smooth or phase in the recognition of these gains or losses over a period of time in order to soften the effects of the short-term market volatility on contribution rates, because averaging the investment returns over a period of time will result in greater rate stability over that period of time. The current smoothing method for Left Plan 2 recognizes these gains or losses over a period of up to 8 years, depending on how large the gains or losses are. Next funding goal is an asset value corridor. And what this does is smoothing investment return results in a variance between the true market value of the assets in a retirement fund and the assumed value, which is used to determine the contribution rates for the plan.
Representative Burkus.
Thanks. Quick question here. I
Yeah.
just got back, so I don't know if this is good or bad, but from CAP training. Went
that's
for my
good.
certification last week, and hopefully haven't heard the results yet, but it was 4 full days of fun. One thing that was brought up on the asset smoothing and the corridor from the actuaries that were speaking to us were that like a 5-year corridor or a 5-year asset smoothing should see give or take like a 15% corridor. And the surprising thing to me is they would recommend that the longer the smoothing, the smaller the corridor. And so I was hoping, I don't know if you could provide information on it, or maybe Lisa from the actuary's office. Is that something that we also prescribe to, or because it's 30%? When I was explaining to them that was our corridor, they thought that was a very large corridor for the amount of time we're smoothing assets.
Yeah, I would ask the actuary to explain some of the specific funding goals that the plan has, if she wants to.
And there she is.
That's a tough question to answer. I think what I can say is our smoothing is different than most companies will use. They'll use a set 5-year. Everything is smoothed 5 years, whereas we have this varying depending on how large it is. So I think that comes into play as well. And so it's really the corridor, as Ryan is speaking to, is really to just try and keep some consistency with that market value. I think it's worked very well for the plan, but I'll get back to you if there's more information on that. But there is a difference in how we do it because it varies.
And to add on top of that, Lisa can correct me if I'm wrong, but we very rarely get to that, anywhere near that 70 or 130 edges of that corridor.
Yeah, OSA. Well, yeah, OSA did a presentation, and it's like even in the big market run-up at the end of the 90s, we never got outside the corridor, and even after the cataclysmic Great Recession market crash, we never got outside of the corridor. So that did raise the question of is the width of the corridor really is it accomplishing what's it accomplishing? Because as a practical matter, that was a Left 2 board bill. As a practical matter, it's never come into play since it was adopted.
Okay. Yeah, just to finish up, Left 2 does use a 30% corridor, which means the actuarial value of assets can't fall below 70% or above 130% of the market value of assets. The next funding goal is minimum contribution rates. They're often referred to as a rate floor, and these are used to ensure that short-term contribution rates do not drop below the expected long-term cost of the plan by more than a set amount. A rate floor is particularly useful for stabilizing contribution rates during periods of better than expected investment returns and when there are short-term variances in planned funding levels resulting from the changes to assumptions or the planned funding method. The Left 2 board adopted 90% of the expected long-term cost of the plan as the rate floor for Left Plan 2, so that's what's in statute. When we get to the options, you'll see kind of the difference between the two with what is in statute and what the board has actually adopted historically with their rates, because historically you've adopted 100% floor rather than what's in statute as the 90. And lastly, multi-year rate plans. Adopting a multi-year contribution rate plan is another useful method for improving short-term predictability of contribution rates. If you're sensing a pattern, stable contribution rates, almost every goal you got that the board has enacted has been with the end goal of having stable contribution rates. The contribution rate may vary during the period of the plan or remain level depending on plan funding needs. The board adopted a 4-year schedule for contribution rates in 2008, which sets rates for the entire period exactly equal to the expected long-term cost of the plan. So basically what this means is that you guys adopt 4 years worth of rates rather than just a biennium worth of rates like the other plans do. And now to get into the two funding methods. The first is the aggregate funding method. This method has only one component to it, and that's the normal cost or the expected long-term cost of the plan. The normal cost takes the cost of all future benefits and spreads that out over the future payroll of all current members. When LEF 2 was created in 1977, the aggregate method was chosen by the legislature as the plan's funding method because it was particularly well suited to accomplish two pension funding policy goals which were considered important at that time: long-term stability in rates and full funding of the plan of all plans on an ongoing basis. As part of its strategic plan in 2004, the board adopted the policy goals of rate stability and full funding and reaffirmed the use of the aggregate funding method to accomplish these goals. The aggregate funding method promotes long-term stability in rates because it's designed to fund the cost of the plan as a level percentage of pay over a member's working career. The contribution rates paid by the plan members and their employers would theoretically remain unchanged for the member's entire career if the plan's long-term economic assumptions and assumptions regarding member behavior were always 100% correct, which does not ever happen, but to the extent that those assumptions prove inaccurate, any difference between what is expected and what is experienced, such as lower than expected investment returns, is reflected in the plan's cost each time the plan is reviewed, and then a new long-term rate is calculated from there. Therefore, short-term rates can experience some volatility. A plan using the aggregate funding method will always want to be at that 100% funding level. If the required contributions are paid, it will never have a surplus or an unfunded liability. And then the second is the entry age. Are there any questions on aggregate before I move on to entry age? Okay. The second funding method is the entry age normal cost method, and this actually has two components. It has that normal cost or the expected long-term cost of the plan, and then it also has an unfunded actuarial accrued liability, or UAL. And that UAL refers to the difference between the actuarial value of assets owned by the plan and the total benefits that are due to be paid. Liabilities are created when the actual plan investment returns are less or more than the assumed returns, and when other plan assumptions are realized, resulting in actual costs exceeding or below what are predicted costs. Both of these components are necessary in this particular funding method to achieve the goal of fully funding the benefits when they're due. The normal cost is more stable under entry age because it doesn't include any of the experience that differs from assumptions, and that's what the UAL component is actually used for. So the normal cost only changes when plan assumptions are changed. And lastly, get to what the board has historically used. So the board has two policies in place when it comes to the funding method. Long-term, as I mentioned in statute, is aggregate with a rate floor of 90% of the entry age normal cost. Short-term is aggregate with a rate floor of 100% of the entry age normal cost. But under the board's temporary funding policy, the amortization of that UAL has actually been eliminated. Instead, you've tied rates to the normal cost and allowed that UAL to fluctuate up and down depending on investment performance. And this has provided more stable rates than simply using entry age. But there is one downside to not using that, the full entry age normal method, because the plan can become too overfunded or underfunded because the UAL portion is being ignored. But it has proven to provide most stable rates out of the three methods that I've talked about. This is just a little graph from last October's meeting where Steve and Lisa had the funding discussion. And it shows the rate path based on the two different funding methods and then what the actual adopted rates have been. And that brings us to our policy options. As Steve mentioned, we're not expecting a decision today. Final will be in July, but this is kind of what the board will be looking at. The first would be to continue what you have been doing for the last 10 years and using these two funding methods with the short-term and long-term. Or you guys could change the long-term method to what you've done in the short term, but there's questions then, how do you want to manage the UAL? Do you want to amortize? For Left Plan 2, the UAL is actually negative, so you have a surplus. So you want to look at amortizing that surplus out. And then there's also the option to set a funding ratio corridor, which means if the funding ratio was to be above or below a certain level, that would trigger an increase or a decrease in rates.
Good, Mike.
Thank you, Mr. Chair. Ryan, would we be, as I know this is a little bit down the road, but would we be looking at this as just as a continued board policy, or would we be looking at statute change?
That's
That's a good question.
Yeah.
It's within your authority to do it as just a continued board policy. That leaves sort of one of the issues that Ryan spoke to earlier, where you've got a statutory method and a method that the board's adopted under your authority, and the actuary is having to report on both. So there are pros and cons. If you were to do it, in statute, you would eliminate that inconsistency between the two. The board in the past, for instance, the 90% floor that's in statute now, that was a board bill. The market corridor, that was a board bill. You have recommended legislation a number of times in the past regarding how you manage this process, but you don't need to. And there'd be the pros and cons. If you put the funding policy out there as a bill, then like any bill, it'll go through the legislative process, and what will happen, what will come out of it, what if that's different from what you desire? That's one thing. But those are the types of issues that we would be talking with you about if you decide to move forward on this one in July. Pros and cons of doing it legislatively.
Any other questions for Ryan? All right. Thank you, sir.
Okay. Yeah, we could get lunch ready for you, or you could continue to move forward. You're a little bit ahead of schedule at the moment. The next two presentations on rates, the base rate and the supplemental rate, kind of go together. So rather than maybe breaking those up with lunch in the middle, would it make sense to take lunch now and take care of the admin update while you're eating, and then knock out the rate ones after lunch? All right.
Great. All right, thanks, folks. We'll go ahead and get our meeting back to order and continue on with our presentation on our outreach activities from our Executive Director, Steve.
All right. First up on the administrative update, expectation interviews have started, and there's only a few left to be scheduled. So please check with Jesse about getting yours scheduled if you haven't already. Yesterday, both the Select Committee on Pension Policy and the Pension Funding Council met. You've already heard, the SCPP heard from DRS about the same issues that you heard from DRS about today. And OSA is also planning on having an educational briefing in July about the smoothing method that's currently being used in the plans. In his presentation, Ryan mentioned that the aggregate funding method was set for Left 2 in 1977. All the Plan 2s were created in 1977, and the aggregate method was set for all the other plans as well. So there has been a bit of interest in understanding what you have done different from what the other plans have done and how that's worked. See, the Pension Funding Council is working on their proposals for contribution rates for the other plans. So they're not talking about funding methods or anything along those lines. They are looking at continuing the last piece of the phase-in of, I think it's mortality improvements, and they've got a couple of options anyway in terms of how that'll affect rates. But rates are going to be going up for the other plans. So they got a presentation on what's happening with rates and what's happening with funded ratios, but the Pension Funding Council didn't take any action. They're expected to take action in July, same as you, so that DRS can notify employers and so that the state and other budgeting organizations can start preparing for their expected pension obligations. See, the next week, the Washington State Council of Firefighters will be having their annual convention. It's in Kennewick. I'll be there and Ryan will be there. We'll have a Left 2 board table where members can come up and we'll answer questions about what the board is working on as well. And then to the extent that the Firefighters Legislative Committee, which will be meeting during this time to develop possible resolutions for the State Council, to the extent that they have any questions about what the board is working on related to pensions, we'll be there to answer those questions as well. With that, I think we also a quick admin note. The Novus platform that we've been using is going to be getting replaced by a web-based portal. Tammy's the lead on that. She'll be communicating with you, and we'll have that. The target is to have it ready for the July meeting. And so again, Tammy will be coordinating with you as far as that transition goes. And Tim, if you have any challenges reaching Tammy. Now, with that, I'll call up Ryan. In July, one of the most important responsibilities of the Left 2 board, one of your most important responsibilities as trustees, is to adopt the contribution rates for Left 2. You adopt the rates for the employer and for the plan members and for the state, which is about $140 million per biennium, roughly, responsibility. The rates for the next biennium will be changing based on some of the assumptions that have changed or could be changing, the required costs. That's the base cost that Ryan will be talking about first. And then as a separate issue, there was a bill passed last session related to PTSD presumptions that also had a cost associated with it, an actuarial fiscal note. That's the supplemental rate that Ryan will be talking about following the base rate discussion, which will start now.
Thanks, Steve. Mr. Chair, members of the board. For the record, Ryan Frost. Before I get started on this, I just want to piggyback on one thing Steve mentioned, his admin update about on the PFC looking at phasing in the mortality assumptions. That was something the board fully adopted 6 years ago, and the other plans have been phasing in those mortality improvements over the last 6 years. So it's nothing for the board to be concerned with. So this is the contribution rate setting options. First, wanted to start off what's the purpose of contributions, and that is to pre-fund the pension obligation. Members and employers make contributions to the pension trust fund. It's only during the member's working life as a percentage of their salary. Those contributions are invested and grow with earnings, and the goal is that the accumulated fund at retirement should equal the cost of all future benefit payments. In even-numbered years, the board has a statutory duty to set contribution rates for LEF 2. As Steve mentioned, they come in two forms: a base rate, which is used to pay for the cost of the plan, and a supplemental rate, which is used to pay for the cost of additional benefits added to the plan. The board adopts the required rates for members, employers, and the state. They are split on a 50-30-20 basis, 50 member, 30 employer, 20 state, and calculates a percentage of employee salary. DRS then collects those required contributions on a monthly basis and transfers them to the LEF 2 retirement fund. Prior to the creation of the board in 2003, the basic rates for LEF 2 were set by the Pension Funding Council, subject to revision by the legislature. The PFC would then receive contribution rate recommendations from the actuary's office on all the state retirement plans, including LEF 2, and that same process is used today for all other plans. But now, after the creation of the board, OSA makes recommendations to you directly, and the board decides to set their own contribution rates. As I mentioned, under Washington state law, in July of even-numbered years, the board reviews these basic rates that are recommended, and these are all based on actuarial valuations which are performed on assets, participants, and plan information compiled in odd-numbered years. In calculating these base contribution rates, OSA applies the applicable funding policies that I mentioned in my last presentation, and then after that, the board adopts those rates. As Steve mentioned, there are two types of rates. I'll go into each of them a little bit: the basic rate and the supplemental rate. The biennial base contribution rate is based on the level of benefits in place at the time the underlying actuarial valuation is performed. The base rates for LEF 2 were established on an ad hoc basis prior to 1989, but generally were only changed every 2 years unless there was a benefit increase. Supplemental rates are calculated and charged whenever there's an increase to the benefits. These supplemental rates are still adopted by the board, and they are included in the basic rate at the beginning of the next contribution rate setting cycle, which can be a little confusing sometimes because the actuaries, when they send their rate letter, it's combined, but the board actually has the authority if they want to adopt that or not. So pension plans commonly have other goals related to plan funding in addition to the primary goal of providing the necessary funding to pay the full cost of the plans. I've talked about these in my funding methods presentation about having a fully funded status, which is to maintain 100% or better funded status, and also, again, stable contribution rates with predictable increases. Previously, the previous rate setting decisions, as I mentioned in my funding method presentation, the board adopted a 4-year rate phase-in in 2005, as well as the goal of rate stability. You guys also set a contribution rate floor. As I mentioned in statute, it's 90%, but historically you have used 100% as your rate floor. You've adopted supplemental rates in 2003, 2004, 5, 6, 7, 9 for a total of, there's 10 different bills that you actually adopted supplemental rates on. And again, you also adopt rates on a multi-year basis, so you adopt rates for 4 years. And then this was a chart I mentioned in my funding method presentation, but you can really see at the inception of the LEF board, rates were at an all-time low, and it really required a step up in rates to hit that expected long-term cost of the plan. And now you can see since 2007, those rates have stabilized after you got those rates up. So that brings us to our policy options. You could continue the current rates. Rates have already been adopted for 1921, and they are sufficient to fund the cost of all benefits of LEF 2. These rates are based on the 2015 actuarial valuation, so they are a couple years old, but they include subsequent temporary and supplemental rates prior to 2018 legislative session and adopted by the board through 2021, as I mentioned. Or you could adopt rates based on the newest valuation results. The preliminary contribution rate levels from the actuary's office are lower than the rates that are currently being collected, due in part to lower economic assumptions that the board adopted last year. For background, that was to lower the investment return assumption, which added cost, but then you lowered the salary growth assumption and lowered the inflation assumption, which resulted in savings, and those savings were more than the cost of what it cost to lower the investment return. And if the board did elect to adopt new rates based on this val, there are two possible options. Again, you could adopt based on the long-term funding policy and statute, which is 90% of the entry age normal cost. This is consistent with the plan's actuarial cost method and includes the minimum rates under the board's long-term funding policy. Or you could adopt rates based on 100% of the entry age normal costs, which is consistent with what the board and the plan has experienced and actually adopted.
Yeah. Representative Berquist, question?
Thanks. So I was kind of learning a little bit more about this. Most plans that was hearing about don't even know what 90% EANC means. Is that like only something that our state has done in the past, or just the LEF 2 board? Or because it sounds like 100% is generally what people just do, and that's how the method's determined. Is there something you can add to that?
Yeah, generally the most common funding method is aggregate, and so it ignores everything that has to do with the entry age normal cost. And so they're basically trying to, going back to the funding method presentation, they're looking at what the cost is going to be for that entire member's life and trying to raise rates or lower rates to hit 100. And so that can be volatile. But what the board has done is they have the aggregate method in statute, but they have also decided to adopt a rate floor to help with some contribution rate stability and not allow rates to jump up and down.
And that's what the 90%?
Yeah, the
piece
long-term
is?
goal
Okay.
is 90% of the entry age normal cost. So it's aggregate with a 90% entry age normal cost, which is called the rate floor.
Perfect. Thanks.
And this next slide will explain a little bit better. Option one would be, as I mentioned, to continue the current rates, which are 875, 525, and 350. Option two would be to adopt, based on the long-term policy and statute, of the 90% entry age normal cost based on the newest valuation. And I did want to mention that this does exclude the recommended supplemental rate increase that the actuaries recommended. So I think Lisa mentioned that she might want to speak to if these are still reasonable, if that supplemental rate is not included in these. I just wanted to make that clear that these rates do not include that supplemental rate, since I'll be talking about that next presentation. So that 90% floor number is 769 for the member, 461 employer, 308 state. And the third option would be to adopt, based on what the board's historically done, 100% of the entry age normal costs based on the newest valuation, which would bring the member rate to 854, the employer rate to 513, and the state rate to 342. As far as next steps, Milliman, the outside actuary, will present their preliminary audit results next meeting in July. That's also when the board is tasked with adopting their contribution rates, and those rates will be effective July 1st, 2019 through June 30th, 2021. And supplemental rate changes can occur outside of the basic rate process. So if another bill was to be, if a benefit was to be passed next year with a supplemental rate increase, then the board would be tasked with adopting that. And those rates become effective in September, which I'll talk about this next presentation. I'll go back to this slide, but I'd be happy to answer any questions.
No questions for Ryan?
And again, you're seeing slightly lower rates because of the savings from those new economic assumptions you adopted last year.
All right, Steve, you want to go on to move into the next one? Or
Yeah, if there are no questions, we'll go ahead and move on to the supplemental rate presentation.
Sure. For the record, again, Ryan Frost. So the issue here is that a supplemental rate increase may be necessary due to the passage of Senate Bill 6214, which added PTSD to the list of presumptive occupational diseases for workers' compensation. Again, as I've talked about, even in my last two presentations, one of the main goals of the board is to maintain the financial integrity of the plan. So to maintain that goal, it's maybe necessary for the board to pay for new benefit improvements through the adoption of a supplemental contribution rate. The board is required to use an accredited actuary using approved actuarial methods to determine the cost of the plan and the cost of any benefit improvements. The cost of the existing benefits in the plan are paid for by that basic rate that I mentioned, which is established by the board every 2 years. And then any benefit improvement is paid by a supplemental contribution rate. And these rates are generally adopted by the board at the July board meeting following the passage of any legislation. So if for any bill that passes in March 2018, then in July 2018, you'd come back with either adopting or not adopting a supplemental rate to be effective September 1st. So the cost of any additional benefits granted by the legislature sometimes require a supplemental rate increase. DRS in turn is required to give affected employers a 30-day notice prior to the effective date of any rate change. These supplemental rate calculations are performed by the Actuary's Office for all pension legislation, and the result of that calculation is reported in their fiscal notes. But those rates must be adopted by the LEF 2 board for LEF Plan 2. And also the board has all supplemental rate recommendations audited by an outside actuary, which I'll get to in a little bit of their findings. So how does OSA calculate the supplemental rate? Basically, they evaluate proposed legislation, they develop assumptions for how that legislation will affect future benefit payments and future plan experience. They'll calculate any expected increase in plan liabilities and determine what increase in contributions, if any, is sufficient to offset that increase in liabilities. The development of these assumptions for fiscal notes may and some often do differ from assumptions used in their valuations. Not all benefit improvements will have cost sufficient to actually increase contribution rates, but if they do, as I mentioned, the board has the task of evaluating the feasibility of adopting any supplemental rate increase. Here's a bit of supplemental rate history. The board has considered a supplemental rate increase for 14 different benefit improvements. The board has adopted the supplemental rate recommended by the Actuary's Office for 10 of those, but the board has not adopted the supplemental rate of the last 4 recommendations. In 2 cases, it was determined that the adopted rates, the base rate was already sufficient to cover the funding requirement of the new benefit. And then in 2 other cases, the rates were left unchanged because it was decided that the cost of the benefit change would be better off allowed to emerge in plan experience rather than from the actuary's assumptions. As I mentioned, this is due to Senate Bill 6214, the PTSD bill, which is the actuaries predict will have an increase in duty-related benefits, which are more costly than non-duty benefits. They estimate that it would create the cost impacts as outlined in this table. A total of a 10 basis point increase, half of that going to the member, 30% of that going to the employer, 20% of that going to the state, and then the budget impacts in dollars are in the right chart there. And as I mentioned, there is an audit on all rate recommendations. It's the board practice to audit fiscal notes for legislation, any legislation passed with a cost. The board has used Bartel and Associates, has been retained. They've completed many previous audits for the board, and we got their letter early this week, so it's not, I don't think it's in your packets, but I'll make sure it's included for July. But on their review, they agreed that all these supplemental rates are reasonable. The actuary supplemental rates are reasonable. And that brings us to the options. The first option, and these will all be tied in into one presentation in July with your other contribution rate decisions. But you could adopt the supplemental rate increase as recommended to become effective September 1st. And you could just adopt that and not adopt any of the other rate changes. Second, you could adopt the supplemental rate increase along with any other contribution rate changes that the board may make in July, and have those become effective the following July. Or the board could just not choose to adopt a supplemental rate apart from any other change that the board wants to make to rates. As far as next steps, as I mentioned, July is rate decision month. So that will be when you have the option to possibly adopt these supplemental rates. And with that, I'd be happy to answer any questions.
Representative Berquist.
Thank you. So, kind of what you're not exactly saying, but kind of what you're saying, if I'm reading this right, is we're charging 8.75 right now to our members. The other half covered by state and employers. The recommended at 100% entry age normal with the 5 basis point supplemental would be about 8.59%.
Let me go back to that and I'll pull that up for you.
Yes.
It's close to that.
There's two different numbers in play. So you're talking about 875 now. Under the way the supplemental rate process would normally work, that would mean this September the member rate would go up to 8.8, and the employer rate and the state rate would go up as well. And then next July, if you adopted the 100% option that historically you've adopted, then rates would go down. So that'll be one of the things that we'll present to you next July is instead of a increase followed by a decrease in the next 12 months, what would it look like just to come up with one number that is level? For instance, that may mean one of the options not passing a supplemental rate increase. If that's the case, how does that affect the base rate number that was originally recommended for the next biennium?
Maybe that number would be 8.57 then.
Maybe. We'll get that number from the actuary's office to find out what the impact on the expected long-term cost of the plan would be if this supplemental rate was not adopted. To kind of so at least there will be an option for you that's smoothed out, where you don't have an increase followed by a decrease.
Mike?
Thank you, Mr. Chair. Ryan, Steve, is it possible to also get dollar numbers with this, not just contribution percentages? I've found that when I'm having these discussions with firefighters and law enforcement officers, they make the argument of, well, we shouldn't have any decrease. We should look at, benefit improvements if we have the extra money, and being able to articulate the argument of, well, it's not just our contributions going in there, it's also employers and the state contributions, and that affects other budgets.
Yeah, I can definitely get dollar figures for these.
Great, thank you.
Oh, yeah.
I will include it for July. I will include it for July as its own slide.
Representative Holy?
Oh, thank you, Mr. Chairman. Steve and Ryan, when we looked at this a ways back here and proposed this in the first place, there was a bit of a question as to whether this created a potential for abuse on this, or this would be something to be uncontrollable or unmeasurable out in front of us. It seems that somebody's taken a hard look at this, that the actuary has, and if we're talking about a total of 10 basis points or 5 to a member, that almost says that they don't believe that could happen, or their projections say that this is probably the total exposure. Can you address that a little bit?
You're talking about the fiscal note for the underlying bill, for the supplemental rate, the PTSD bill.
Yes.
Yeah, the bill went through the legislative process, and there were a number of amendments to the bill to address perceived concerns about the likelihood of abuse. Elle and I did a lot of work on how they feel it will change their assumptions regarding increased number of claims. That was in their fiscal note. And then OSA took the approach of saying, the bill's not going to change how many people have PTSD. It's just going to change how many people now have a duty-related disability as a result. And so it's transferring some costs from non-duty to duty-related. But then with respect to death benefits, there was also an increase. Currently, duty-related deaths as a result of PTSD, that was actually something that I don't think a lot of people, DRS, me personally, were aware of prior to this legislation. But Elle and I will treat a suicide resulting from a duty-related mental condition as a duty-related, or as a death in the course of employment. And so that added an increased cost in that area. It wasn't that these were being calculated as non-duty. Currently, there would be no benefit paid there. So OSA did a good job with their fiscal note identifying where the increased costs come from. And again, you're talking a total of 10 basis points out of a 1,700 basis point total for the plan. So that kind of puts the increase in scale of the total plan. They also, though, identified there's not a lot of data out there. So actual experience for some of these things, they had to reach out and look at national databases and make some assumptions there for their fiscal note. And I believe Marilyn Oliver agreed that the rates were reasonable, but also identified that there's not a lot of data there. I think, Lisa, would you like to speak to the fiscal note a little bit more as well? I don't mean to put you on the spot.
No, I brought my fiscal note with me. I'm ready.
Oh, there you go.
I just wanted to come up to share a couple of things because I think it might be helpful. From a disability perspective, that does not have a very big impact on your plan. So if for some reason we saw a much higher incidence of disabilities being classified as duty-related because of this new bill, it will not have a very big impact on your plan. The analysis we did, I think the disability was like 7% of the cost. The costs really come on the duty death side, and particularly because of the large duty death lump sum. That has a big impact on the cost to the plan. I think if you saw a lot more PTSD disability claims, I think it's more from an HR perspective as far as, head counts, right, of your plan. That will be a bigger impact than the retirement plan costs, if that's helpful.
Yeah, as far as numbers go, the 2 non-duty deaths are now presumed to be duty deaths annually. So that's...
And then we'll have the option when you, in July, as Ryan mentioned, these will kind of be rolled together. You won't be making separate motions to adopt a base rate and a supplemental rate. We wanted to break them apart for you in terms of the presentation so you understood some of the underlying issues, but you'll have one set of rates with a couple of options to vote on in July.
Yep.
Other questions for Ryan? All right. The last item then on the agenda is the agenda items for future meetings. The July meeting is going to be very important. The board's trying something new this year especially for the newer trustees. So, for instance, one of the things that you're doing differently this year is instead of voting on these plan benefit related issues like the DRS request legislation or career change, instead of voting on those as they're presented to you, you've kind of deferred them all to July so that you can consider the interim as a whole. Historically, what's happened is as you take them one at a time, it's hard to evaluate then how many you're taking on, because in the next month there might be more, and the month after that more. But it puts a lot of emphasis now on the July meeting. There'll be a lot for you to consider with respect to the rest of the interim's work plan. Similarly, as I mentioned earlier, your most important statutory responsibility is the adoption of rates. You already have rates in place for the next biennium. The question is, do you want to change those rates? And you'll be voting on that in July as well. If any of you are going to have conflict, unexpected conflict between now and July, something comes up, please let us know so that we can coordinate and make sure that there's a quorum and that we can assist you, for instance, in participating by phone or some way, even if it's just for the key part of the meeting where you're making votes. But the July meeting, because there's going to be a lot going on, it could be a little bit longer than usual, and you will have a number of decisions to make. If between now and July you have any questions about any of these ahead of time, please don't hesitate to contact Ryan or Jacob or me, and we'll do our best to answer your questions ahead of the meeting so that you can go into the July meeting feeling as fully prepared as possible. You won't be seeing anything different in July that you haven't already seen before in terms of information or options. There may be the cost dollar information that we talked about today with respect to the rate options and this combined, for lack of a better word, supplemental base rate option that we also talked about from the actuary's office. But this should all be, there shouldn't be any surprises in July, but if you've got questions remaining, or if as you think about the presentations, a question comes up, please reach out to us. Don't feel like you have to wait till July to ask your question and get it answered. Then, and your work plan, also, if I can give you a little bit of encouragement, your work plan took into account that you would get everything done in July so you could cancel your August meeting. So that's another reason to come to July ready to go and prepared. It'll give you August off if you can take care of business. Senator?
Yes, so that week in July is the PennWAR Conference in Spokane. It's a regional economic summit, lots of legislators from other states, lots of involvement with different stakeholders. I'm part of the host committee. I'm not sure about Rep. Holy, but I certainly hope you have the option for me to call in.
Yes.
On that one. And then if we're going to be updating our servers or whatever that is, will that be done before that meeting so that I could call in?
It will be, and it won't affect the call-in. It'll just affect how you see the documents that you'll be considering.
Okay, I'd like to see those. So
yeah, and if we will make sure that you have everything one way or another. If there's any hang-ups, we'll stick with Novus if the transition to electronic transmission, and we can, if worse comes to worse, we can get you paper copies of everything. But you'll have all the materials, whether you're phoning in or not, one way or another. Or I'll hear about it in my next evaluation. All right. Let's see. Any other issues related to future agendas?
Possibly. I just got an email, not just, I got an email a couple days ago from NC PERS regarding the Public Employee Pension Transparency Act on the federal level. Is there anything that we should be doing or should be considering on that as far as sending? Or
Historically, the board has not specifically weighed in on those. The board is a member of NC PERS, and so any decision, in a sense, any presentation or concerns raised by NC PERS are chaired by the board in that sense. We haven't added on top of NC PERS's voice in the past. There was, you'll recall earlier this session, there was also some federal legislation that was a concern to the SIB that they mentioned, particularly asking the board to weigh in on. I don't know if concerns over federal legislation is just, there seems to be a growing number of concerns, especially related to pensions and the effect of federal legislation on pensions right now, and I don't know if that may mean that we could talk about that as a strategic thing maybe at the October offsite in terms of whether you want to weigh in on federal issues more than you are now, and if so, how you would go about doing that? Does that work? Yeah. Okay. Tim's writing that down right now for make sure it's on the October agenda. And it'll be in the minutes. Thank you, Jesse. Other questions? The Public Employee Pension Transparency Act is specifically, it has to do with requiring all public pensions to report certain information to the federal government. What happens, though, is in order to report that information, the federal government requires that it be according to their assumptions, their methods, which in all likelihood differ from the assumptions that we're using or any other plan uses. There's a whole host of, there's 6 different actuarial methods and a number of different funding policies that can vary on those methods. And so that's where the issue has come up in the past. The state does a CAFR. We do annual actuarial valuations. Those are already public. They're reported on the website and shared with groups that track this, like NC PERS. So that's where historically the concern has been. It's creating an additional workload, and then perhaps also concerns over the specific required assumptions that are used as part of that. How that information will be used, and how is that different from any of the information that's already being provided. You guys are ahead of the curve as far. Not all plans do annual actuarial valuations. Not all plans review their long-term economic assumptions as frequently as every 2 years. Not all plans regularly review demographic assumptions like you do. It can be ad hoc. And not all plans report their information as publicly as you do and as all the plans in Washington do. So some of these federal proposals tend to be directed towards, they're not directed towards you. You get caught up, though, in the same workload and splatter of that's being directed towards maybe county plans or smaller municipal plans around the country who don't have the resources to deal with their responsibilities quite the same way that you do. Other questions? All right, then I will see all of you in July or speak to you on the phone in July, if not sooner.
All right, no further questions, comments, meeting's adjourned. Thank you.